Hello dear traders, the beginning of a new week is quite volatile. The already weak demand for risky assets dropped amid the situation in the Middle East. As a rule, geopolitical crises in this region lead to higher oil prices and cheaper stocks. In other words, oil surged, thus forcing managers of global hedge funds to sell US stocks vulnerable to commodities. A tough situation at the onset of this trading week is discouraging investors. The final data on the US labor market turned out to be strong. Against this backdrop, the S&P futures slumped. Under the current conditions, such data is considered a signal of higher interest rates, which will have a negative effect on the stock market. All these events are taking place ahead of the publication of the US inflation figures. Let us find out how the market will react to what is happening. Stay tuned. The financial world is always rich in unexpected and interesting events, so watch the video till the end and share your opinion in the comments. Traders are likely to focus on the publications from the United States, including inflation figures, FOMC meeting results, statements of the Fed officials, wholesale prices, and consumer sentiment data from the University of Michigan. Traders are trying to predict whether the Fed will resort to one more rate hike to cap inflation. Data for August reflected the sharpest rise in inflation in the last 14 months. This could be mainly explained by a jump in fuel prices. At present, oil costs $90 per barrel, which confirms that the energy issue is still on the agenda. The ongoing rise in oil prices could become one more burden for consumers. This, in turn, will boost inflation, thus affecting the stock market. Given the tension in the physical oil markets in the fourth quarter of 2023, a possible decline in oil exports from Iran may cause a jump in Brent crude to $100 per barrel in the near future. Thus, high figures may intensify concerns about one more key rate hike. Notably, in September, the Fed's decision to keep interest rates high for a long period made markets nervous. Most analysts suppose that at the meeting scheduled for October 31st, November 1st, the Fed will keep its rates unchanged. However, some speculators are betting on a new rise. Also this week, such large companies as Citigroup and JP Morgan will start disclosing their earnings reports. However, reaction to the data could be moderate because of the escalation of the geopolitical tension. Nevertheless, it does not matter that traders should ignore such reports. On the contrary, they may find a lot of useful information for the future. On October 13th, JP Morgan, Citigroup and Wells Fargo will report their third quarter 2023 earnings results. They will also reveal how the key interest rate hikes have affected the need for loans and consumer spending. PepsiCo, a beverage and snack manufacturer, Delta Airlines and insurance company United Health Group will also publish their reports. In general, analysts suppose that in the third quarter, earnings of the S&P companies increased by 1.6% compared to the same period of the previous year. In the second quarter, the indicator dropped by 2.8%. On Monday, almost all U.S. key indices opened with a decline. Curiously, on Friday, the market surged despite decreased during the previous session and managed to close in the green. In particular, the S&P closed the previous week with a rise of 0.6%. On Friday, it jumped by 2% from its daily high. However, such a situation created favorable conditions to open trades in the opposite direction. The main target for the S&P, which is hovering within 4,300-200 points, is the level of 4,450. The lowest level was recorded below 4,220. At the end of the previous week, the S&P broke 4,300. If the index falls, the nearest target will be seen at 4,150. The situation in Israel may slow down the recovery of the US stock market. A movement to upper targets is likely to be difficult. A lot will depend on geopolitical events and their importance for investors. The US stock market is showing an alarming dynamic. Negative news about the geopolitical situation or an economic downturn could lead to a massive sell-off of stocks. From a more general point of view, the situation is a bit different. The stock market has been stable all year. Regardless of considerable losses in August and September, the S&P is still trading 10% higher than in January. Meanwhile, the Dow Jones closed the previous week with a hardly noticeable increase. It dropped like other main indices at the start of the new week. The yield on a 10-year US bond recently exceeded a 16-year high. These can serve as an omen of future problems. The current situation evokes associations with unpleasant historical events in 1987. Then, stocks held steady despite the rise in bond yields. However, one day the Dow Jones tumbled by 22%, showing the largest one-session drop in history. Uncertainty about the economic trend is increasing, while expectations have been changing throughout the year. Although experts are enthusiastically talking about a possible soft landing of the economy by the middle of 2023, the recent jump in bond yields may radically change everything. According to the forecasts provided by the Federal Reserve Bank of New York, the risk that the US will enter a recession by August 2024 is now 61%. Last week, the best performance was manifested by the Nasdaq. On Friday, one of the most volatile indices jumped by 3%, whereas its weekly gains totaled 1.5%. Analysts are keeping a close look at the area around 13,000 points. Investors seem to consider this level to be important psychological or technical support. If the index touches this level and falls to break it down, traders may define this as a positive signal. What's more, the level of 13,500 could be considered the next important area of resistance which the market is likely to approach. If the Nasdaq climbs to this level and upwardly breaks it, the upward cycle is likely to continue. In light of the upcoming reporting period, traders have focused on the companies that will publish their future figures in the coming days. Thus, Delta Airlines looks attractive to investors. According to the data for the second quarter, the company improved its forecast for earnings per share and profit margin for 2023 thanks to the mounting interest in the air travel. Analysts suppose that earnings per share may reach $1.94, which is more than the previous figure of $1.51. Revenue is expected to increase by 13% compared to last year after an 11% jump in the second quarter. By the end of the year, stocks of Delta Airlines may climb to $59, which is 60% more than the current price. On Friday, the share price climbed by 1.5% to $37. The price started to rebound from the support level located between $36 and $35. It's likely to advance to $40. And we continue to monitor the stock market situation to keep you abreast of recent events. Subscribe to our channel and leave your comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.